Hello and welcome to this episode of Old Square Tax Chambers Tax Snacks. Today I am talking about what is at least the third iteration of settlement schemes in relation to the loan charge, which for those for those who've been asleep for the last 10 years or so, is a charge which accompanies Part 7A income tax and national insurance tax charges in relation to loans and quasi-loans made in relation to employment income. It was introduced by Finance Number 2 Act 2017 and has caused a great deal of consternation. We had the Morse review, we've now had the McCann review, and I wanted to talk about this at the moment because at the date of recording, the 31st of July 2026, this is coming into force next week on Wednesday, on the 5th of August 2026, and so something for once is happening in tax in August. So it breaks that rule that nothing happens in tax in the summer. Let's see if it breaks any other rules too. What I'm going to do in this Tax Snacks is take you through the legislation that brings the new loan charge into being, and also through the terms of the scheme itself, and suggest some ways that might be helpful. So, starting with the legislation, this is found in Finance Act 2026. Starting from section 25, it's only three sections, 25, 26 and 27. This takes us through this is the basic provision that establishes the necessity for a loan scheme. Section 25 tells us that the Treasury must, by regulations, provide for a scheme under which persons who are liable to pay loan charge amounts may enter into a settlement agreement with the commissioners as regards those amounts. So that's simple. This is going to be a scheme established by statutory instrument. And Section 25 goes on to tell us that the scheme must provide, that HMRC must make an offer to enter into a settlement agreement to every person who HMRC believe is liable to pay loan charge amounts, is not somebody who HMRC reasonably suspect is or has been a promoter or introducer. The scheme itself, so this is the LCSS, has to provide that any settlement offer made to a person, imaginatively referred to as P, has to set out the terms of the proposed settlement, which will include the loan charge amount, which are referred to as relevant loan charge amounts. The amount P would instead be required to pay under the settlement agreement, the settlement amount, and remain open to P for such reasonable period as may be specified by the scheme. So that's the basic shape of it. However, Section 25(4) does tell us that the LCSS must provide that relevant loan charge amounts do not include loan charge amounts which are the subject of or under a contract settlement entered into before the 1st of June 2021. So if you've got a pre-June 21 settlement agreement for loan charge amounts, you cannot renegotiate those. And so the effect of entering into a settlement agreement is that every relevant loan charge amount ceases to be or will no longer become payable by P, but P is liable for the settlement amount. The scheme is also going to have to provide for the method of calculation, and indeed it does, we'll see that in a minute, but it has to ensure that those amounts under the settlement scheme are arrived at by determining the value of loans and quasi-loans under Schedule 11 or 12 of Finance Number 2 Act 2017, that's the loan charge legislation, determine other amounts paid to P under the arrangements under which the loans or quasi-loans were made, take into account the amounts charged to P as deductions, fees or otherwise under their arrangements, attribute the amounts determined to tax years in accordance with the scheme, and assuming that income tax and national insurance contributions were payable as regards those tax years in relation to those amounts, and on the assumption determining the total amount for each of those tax years of the additional income tax and national insurance tax contributions, which would have been payable by P as regards the tax year. So essentially the aim is to come up with a sort of equivalent to the loan charge amounts, and that starting amount is then lowered by a number of things, though not surprisingly or unsurprisingly below nil. So the things that you can use to lower the settlement amount are the amount of reduction given by reducing by 10% the first 50,000 of the total amount attributed to the tax year, and the amount of reduction given by reducing by 5% the next 100,000 of that total. And that by doing that, this is going to be the settlement amount, unless it is more than £70,000 lower than the person's loan charge gross liability, and then the settlement amount is the loan charge gross liability less 70,000. So in effect, the scheme gives you a maximum discount of £70,000 against a loan charge. All of the definitions relate back to Finance Number 2 Act 2017, so that includes the definition of loan charge amount. The definition of loan charge gross liability is also related back to that. And so that is the first part of the legislation. Let's now go look at section 26 and 27 just briefly. So section 26 talks about inheritance tax, and of course this is very important because for all of these loan charge schemes tended to have unintended inheritance tax consequences, because invariably they didn't qualify for the inheritance tax reliefs that they were sold as qualifying for, or even if they did, getting money out of them to the people who had generated the value in a particular business became impossible, effectively. So many of these, without an inheritance tax charge, so many of these do have inheritance tax consequences as well. So section 26 provides that the scheme may provide that if a person enters into a settlement agreement, amounts of inheritance tax payable by the person which arise as a result of transfers of value and other occasions of charge occurring in connection with a settlement, that's an inheritance tax section 43 settlement, used as part of arrangements under which the relevant Schedule 11 or 12 loans and quasi-loans were made, and before the end of 3 months after the date on which the settlement offer in relation to the settlement agreement was made to the person and have not yet been paid, cease to be payable by the person. So potentially there can be a very significantly advantageous inheritance tax position here. Section 26 goes on to say, the scheme may provide, if a person enters into a settlement agreement, for adjustments in amounts of inheritance tax payable by other persons which arise as mentioned in subsection 1A, are attributable to property used for making the loans and quasi-loans and have not yet been paid. So those are both optional provisions of the LCSS, and we'll see what's been done in the actual statutory instrument text in a moment. What the scheme has to provide in relation to inheritance tax is that if a person enters into a settlement agreement, no relevant loan or quasi-loan is to be treated as a liability for the purposes of section 5.3 of the Inheritance Tax Act 1984. Now, this is obviously one of the foundational provisions of the Inheritance Tax Act, and it's the one that tells us what a person's estate is. So it's a person's estate is the aggregate of all the property to which they are beneficially entitled, except that there are certain things that are left out of that, and one of them, the one that's excluded here, is, in determining the value of a person's estate at any time, his liabilities at that time shall be taken into account, except as otherwise provided by this Act. So ordinarily, the estate is what you're beneficially entitled to, less what you need to pay out. But if you enter into a settlement under the LCSS, your loans and quasi-loans are not to be deducted from your inheritance tax estate in determining its value. So that is 26, and 27 is some supplementary provisions. It first of all sets out what other things that the scheme might do. For example, it may make provision about the process of making settlement offers and entering into settlement agreements. And it may make provisions supplementing provisions under 25(6) about the calculations of the settlement amounts, and it does do that, and the definitions in section 25(7) of loan charge amount and loan charge gross liability, and it does do that as well. So the important thing to remember is that you cannot just look at either the regulations or the Finance Act 2026. You need to look at them both together. So those are some of the things that the scheme may make provision for. It then goes on to talk about other things that the scheme may do. So, for example, the provisions which may be made under the scheme may make different provisions for different purposes or cases, provisions generally or for specified cases, provisions subject to exceptions, incidental, supplementary, consequential, or transitional provisions. So, in coming up with the form of the LCSS, the Treasury was left with quite a broad discretion. So that takes us on to looking at the actual provisions of the LCSS itself. Now, the LCSS statutory instrument, which is number 821 of 2026, and its proper name is the Employment and Trading Income, etc. Loan Charge Settlement Scheme Regulations 2026, were made on the 14th of July, put before the House of Commons on the 15th of July, so we've only had the text for 2 weeks. But they come into force on the 5th of August, which I think is going to be Wednesday of next week. As I say, I'm recording this on the 31st of July 2026. So if you want to get in nice and early with using them, now is the time to get to grips with them. So let's have a little look at what they say. Regulation 2 sets out interpretation. Of particular importance in here is going to be the definition of settlement amount, which is the amount determined under Regulation 10 or Regulation 11, the relevant loan charge amount, which has the meaning given by Regulation 9(4)A. Those are the two, I think, most important definitions in the whole of this, because you'll remember that those are the two that I highlighted in Finance Act 2026, where the scheme itself makes some changes to them. We then get a special provision in Regulation 3 only about interpreting the loan charge amount. And it explains that loan charge amount has the meaning given by Section 25(7) of FA 2026, supplemented by the descriptions given in the following paragraphs. And those are, and it goes on to say, loan charge amounts which arise in connection with the Schedule 11 or Schedule 12 loan or quasi-loan are any amount of income tax under an enactment, any amount of national insurance contributions under an enactment, any amount of late payment interest under Section 101 of FA 2009, or under a contract settlement on amounts in paragraph A or B. Amounts of income tax and national insurance contributions include amounts self-assessed by a person under Section 9(1) of Taxes Management Act 1970, whether or not that assessment is final. Now, those last words there are quite interesting because that puts two groups of taxpayers, which administrative law would ordinarily regard as having very different profiles, so taxpayers with a final assessment and those without a final assessment in the same boat. And in this regulation, amounts of national insurance contributions are primary Class 1 contributions and Class 2 and Class 4 contributions. So that includes both employer and employee amounts. So, Regulation 4 tells us a bit more about the loan charge gross liability, which has the meaning given in Section 25.7 FA 2026, supplemented by Regulation 4. And it says that when ascertaining P's total loan charge amount for the purposes of determining P's loan charge gross liability, the Commissioner must remove any double taxation of income tax or national insurance contributions in connection with a Schedule 11 or 12 loan or quasi-loan, determine a just and reasonable amount they consider that they would seek to recover from P in respect of loan charge amounts if P were not to accept a settlement offer under the scheme, and assume for the purposes of this regulation that P has or will have the means to pay the amount they determine. So two really important things here. The first one is this: remove any double taxation of income tax or national insurance contributions in connection with a loan or quasi-loan. That's important for two reasons. The first is because on the face of it, that could provide a very good opportunity for simplifying structures. And secondly, because we don't really know if it does or not, because double taxation isn't clearly defined anywhere. So we don't know if that means juridical double taxation, so the taxation of the same amount in the hands of the same person under the same provision, under two different provisions, or economic double taxation, which is the same amount being charged twice in the hands of two different people. Now, mostly when double tax is mentioned, it only means the former, not the latter. However, this is an important possibility. The other important thing is when the just and reasonable amount is being considered, it's going to be considered as if the taxpayer is solvent and can pay a large sum. So there's a deeming going on here. When HMRC consider what they would seek to recover from them in the absence of an agreement, they have to assume a solvent taxpayer able to pay the tax in question, which for a lot of people is not going to be the case, but that is the benchmark against which just and reasonable is going to be considered. So that may pose an issue, because it is likely to mean that just and reasonable is going to mean the full amount of the tax that they could recover from a person with the means to pay it. So let's go on now. Regulation 7 it sets out establishment of the loan charge settlement scheme. It's not particularly exciting. It just tells you that the regulations establish the rules of the scheme. Regulation 8 sets out eligibility, and it says that the commissioners must make a settlement offer to a person to enter into a settlement agreement under the scheme if the commissioners believe that the eligible person is liable to pay loan charge amounts, and the eligible person is not a person the commissioners reasonably suspect is, or at any time has been, a promoter or introducer, or a director or shadow director of a promoter or introducer. So it's very broad. All you need for eligibility under the regulations is that you are liable to pay loan charge amounts. Settlement offers are made in accordance with Regulation 9. Again, that is more procedural, so less interesting, but is worth a look at. It should tell you the shape of what you should expect to receive from HMRC. Very importantly, paragraph 8 tells you how long a settlement offer remains open, and that's going to be 90 days or such longer period as the commissioners may reasonably determine, beginning with the day that the offer is made. So I think realistically you should probably expect to have 3 months from the date the offer is made to accept it. But an important restriction on that is where a settlement offer made is what's considered a further offer, you only get 30 days to accept it. So a further offer is one that is made if a settlement offer in respect of the same relevant loan charge amounts has expired, been withdrawn, or been rejected. So it's not a one and done. You might get a second chance. You might not, because it is that's a power rather than an obligation. The commissioners may make a further settlement offer. If they do, remember that your deadline is 30 days, not 90 days. So we then come to the provisions to calculate a settlement amount. Again, I'm not going to go through these in detail. It's set out in a stepwise process. So you've got steps 1 through 11 under Regulation 10. And then if you have a corporate employer and the offer's made under Regulation 9.3, bear with me, I'll tell you what that says. Regulation 9.3 just tells you that for a corporate employer the settlement offer is made under Regulation 11, not Regulation 10. So if you've got a corporate employer, you're going to have to do your settlement calculation under Regulation 11, and that has 10 steps. So you've got one fewer steps if you've got a corporate employer than if you have a individual employer. So those are the two calculation methods. I don't want to take you through those steps, but do have a look at them. They pretty much produce what you would think they would produce as described by the primary legislation, so in those 3 sections of Finance Act 2026. Regulation 12 tells us the important thing of what conditions HMRC can place on the settlement offer. So again, this is permissive, not mandatory. HMRC may make it a condition of a settlement offer that P agrees to pay additional qualifying amounts on such terms as the Commissioners may propose. P agrees to the withdrawal on such terms as the Commissioner may propose of proceedings brought in any court or tribunal relating to relevant amounts which are the subject of the offer, where those proceedings have not been finally determined. P agrees to forbear from commencing or making a claim in any proceedings against HMRC in respect of relevant amounts which are the subject of the offer. P agrees to forego any claim for a repayment of tax or relevant national insurance contributions. Where the amount P is required to pay by the offer is nil, P executes the settlement agreement as a deed, which is of course to make it binding, and so not a huge surprise. P agrees that a contract settlement agreement entered into before the date of the settlement offer which relates to relevant loan charge amounts is discharged. The proposed settlement agreement is substituted for that contract settlement, and the agreement provides instead for the discharge of every relevant loan charge amount. So to pause there for a moment, I think this is a bit of a sticky wicket. So if, for example, you had some loan charge amounts that you had made an agreement under, say, the 2017 terms, and you still had some outstanding amounts and you wanted to settle those now, HMRC could force you by saying we are making it a condition of this settlement offer under the LCSS that you effectively roll all of the amounts up into our current offer. So where you have an existing settlement agreement, it will be necessary to carefully consider the ramifications of that being changed to the new terms. So to continue, where P has entered into an agreement with the Commissioners to make payments towards liabilities to HMRC which include loan charge amounts, P agrees to the reallocation of such payments to liabilities other than loan charge amounts. So effectively, if you've got lots of outstanding amounts, they could say, well, we want your existing agreement to now apply to different amounts, and then you can have an additional agreement for loan charge amounts on top of that. So for some people, this isn't going to be the best option because you are likely to get those sorts of conditions. Additional qualifying amounts is defined, and these are amounts which are payable or become payable in the future to HMRC and have not yet been paid, and are amounts arising out of deliberate or concealed inaccuracy, amounts under an enactment that are not loan charge amounts and which satisfy the timing condition, which is the amounts arose and were assessed by HMRC on or before 26th of November 2025, or HMRC opened an inquiry into a return in respect of those amounts on or before that 26th of November 2025. So really what HMRC are looking to do with this, or what the Treasury is looking to do with this, is to scoop up anything outstanding and put it all into one agreement, which from a simplicity perspective is probably a very good idea for clients as well. So I don't think that's too offensive, potentially. So moving on, payment of settlements amounts, Regulation 13 clarifies that settlements amounts are treated as if they're an amount of tax recoverable as a debt due to the Crown, and settlement amounts are amounts that P is liable to pay to HMRC under these regulations. So Regulation 14 clarifies for us that HMRC have to credit relevant payments against the liability of P to pay a settlement amount in accordance with this regulation. Relevant payments are essentially payments that were made prior to the date of the settlement agreement. And then we come to inheritance tax. So again, as I've said, when I see loan charge issues and issues around these types of organisation, one of the things that I often see is that the bar to shutting it down is going to be a very significant dry inheritance tax liability. So Regulation 15, which is the first regulation and the only regulation dealing with inheritance tax, tells us the following. If P enters into a settlement agreement, amounts of inheritance tax which have not been paid and which arise before the end of the period 3 months beginning with the day the settlement offer was made to P, to which the settlement agreement relates, cease to be payable for the amounts and by the persons in Case 1 and Case 2, and no relevant loan or quasi-loan is to be treated as a liability for the purposes of Section 5.3 of IHTA 1984. So that echoes exactly what is said in the primary legislation, except we're now going to get, in the terms of these Case 1 and Case 2, we're going to get when this applies. So it's going to be narrowed down a bit, because if you recall, this was one of those things which was a HMRC may, and these are the people and the amounts in relation to which HMRC have decided to exercise that power. So Case 1 is an amount payable in respect of a transfer of value to a relevant settlement by P, where P is not a corporate employer, where the amount is attributable to property used for making the relevant loan or quasi-loan, or was used to make a loan or quasi-loan to any other person, or by P, where P is a corporate employer, or by any other person, where the amount is attributable to property used for making any relevant loan or quasi-loan. So the definition of relevant loan or quasi-loan bears the meaning that it has taken from FA 2026 and which is imported through into these regulations. Case 2 is a settlement charge payable in respect of a relevant settlement by P, not a corporate employer, where the charge is attributable to property used for making the relevant loan or quasi-loan, or a loan or quasi-loan to any other person, or by P, where P is a corporate employer, or by any other person where the charge is attributable to property used for making any relevant loan or quasi-loan. So the distinction between Case 1 and Case 2 is Case 1 relates only to an actual transfer of value. Case 2 relates to a settlement charge, so relevant property type regime charges. So HMRC have gone to that really quite broadly. So this scheme, it has some possible banana skins, but it is certainly very worthwhile looking at with your clients who are still in the position of not having managed to settle their loan charge amounts. That pretty much takes us to the end of the legislation. Now, those with particular experience in this area may recall that with previous loan schemes which were not set out quite so statutorily, or at least set out in the secondary legislation in quite the same way, there have been a number of issues around how that scheme should be applied. And in order to challenge HMRC's application of the scheme, it was necessary to bring judicial review proceedings, which is expensive, difficult, time-consuming, all of those things. And most people who did it, in fact, I'm not aware of any who succeeded, though I can't say categorically they didn't. I'm not sure anybody succeeded on that. So one of the things that is significantly better, in my view, about the 2026 scheme is that it is found in a statutory instrument. Now, there is no appeal process here. So, yes, there is no appeal process here per se. So that is one thing. It doesn't mean you will be able to appeal, but it does mean that the rules of statutory interpretation should be applied, which does give us a bit of an advantage in worrying about unclear language. The bit of unclear language in inverted commas about which I am most worried is that mention of double tax in, I think it's Regulation 4, isn't it? Yeah, Regulation 4.2. When ascertaining P's total loan charge amount, the commissioners must remove any double taxation of income tax or national insurance contributions in connection with a loan or quasi-loan. I have some views on what that might mean, but I don't think it's totally clear. And I'm not aware that we've got any guidance on it. So I think probably it's open to anybody looking to make a settlement offer to suggest what they think that means to HMRC. No doubt HMRC already have a clear idea of what they are and aren't going to accept. So that is a whistle-stop tour through something important that's happening in tax in August, which is the Loan Charge Settlement Scheme 2026 is going to become effective on the 5th of August. If you have clients, if you're looking for clients like this, now is the time to really dig into this and help them to settle these very stressful liabilities. Thank you for taking the time to watch.